hang aside, here there is that fundraise announcement on Friday. So there could be that dilution risk. So that's putting a bit of pressure. But other mid-cap IT too, mildly lower. Birla soft persistent, down about 0.5%.
And I was watching that announcement from Coforge and I was wondering, they've chosen such an interesting date, right? 26th, 5:30 p.m. and people are just about getting into holiday, if not holiday, at least weekend mode.
But really no holiday for the board of Coforge.
No, clearly not. Okay. All right, let's take the conversation forward. Manish Sonthalia is joining in. He's our market master of the day. Manish, thanks so much. You know, human beings are optimistic creatures by nature, and more so if you play in the capital markets. You have to believe that the coming year is going to be better. So we start right there. But beyond the, the well-placed optimism, if you really look at the facts on the ground, valuations, if you look at how India needs to compete with other markets, we're not, an isolated story. It is a connected world. Realistically speaking, do you think that this sluggishness of 25 will finally end as the year comes to a close?
Yeah, good morning, Surabhi. Yeah, I do believe that probably you would have seen the worst in calendar year 25, and more so on account of the Indian rupee, which has been falling relentlessly. 91 is overdone, according to me. And, even the earnings trajectory would seem better going forward. Of course, Q3, we are looking at something like 9% revenue growth and maybe slightly lesser than that on the PAT front. But come FY27, things should look better, more on account of government impetus, and earnings should be around 13-14%. Suffice it to say, valuations are not very expensive. Even Nifty 50 earnings less than 2 peg, even if you believe 11-12% sort of earnings growth, 21-22 times, not very expensive. More so on account of the fact that even the mid and the small caps, particularly the small cap space, is in line with 3-year median valuations, 5-year median valuations. So saying that that space is still frothy, I wouldn't believe so. And earnings trajectory out there is going to be again 14-15%. So macros are improving, valuations are okay, volatility index seem to suggest that neither the bears nor the bulls are in a hurry to sell or buy. There's total complacency, and all of that would mean that, you would have a big trigger either on the upside or on the downside. Markets would wait with bated breath for next 3 months on account of the trade deal to get signed. And so that's how I would believe that the positives weigh more than the negatives.
So Manish, fair enough. Fair amount of factors on both sides, positive and negative. And I want to leave FPIs out of the equation for a bit. We'll come back to the FPI question. Let's talk about domestic flows, right? And that's what supported the market. Now, again, we work with an assumption that the SIP flows, the mutual fund flows will remain steady, and they have been. Between 25,000 crores on the downside in a bit of a weak month to about 35,000 crores in a good month. Now, assuming that remains steady, what is the rest of the local money doing? The so-called local smart money, the family offices, the HNI, the UHNI. Is that money fully deployed? Is there some waiting on the sidelines that could then propel the market higher? Is it going overseas because global markets are doing better? And you have a lot of options coming up in GIFT now, right? GIFT City, to invest in overseas markets. So what is the so-called local smart money doing?
So the very recent fancy for the UHNI family offices is gold and silver. So that has really caught the frenzy, and because markets have been very, sort of...
But Manish, that's not smart, na? Then they're chasing the price, much like how you say that new investors or novice investors do, simply chasing returns.
Whatever it is, they are chasing bullion.
Okay.
That is my observation. The unlisted portion has lost some of its sheen. We saw unlisted shares fancy in the last 2 years, but since the listing, many have listed at a discount to what the unlisted prices were quoting at. That has lost a bit of its shine. And, so it's unlisted, it's basically new IPOs, listing gains and bullion, which is basically driving the market for the UHNIs and that segment. Of course, out here, I would believe that because interest rates in the system are very, very low, this permanent shift from debt to equity is a given. And in time intervals, you'll see the movement between different asset classes. Currently, it is basically favoring bullion.
All right, take that point. Meanwhile, just, our team was alerting us on VIP. There was a large trade on VIP Industries, around 26% equity that changed hands. My sense is that this would be an inter-promoter or a promoter-related deal itself, because no one else holds that kind of equity. And it may be perhaps an intra-promoter transfer where, maybe DGP Securities would perhaps give it to the multiples private equity guys. So we'll monitor how this pans out. But as of now, the stock has been a rank underperformer below the deal at which, the business was sold as well. So right now, post this last trade, we've seen a bit of a spike.
You remember that price, Maklam, off the top of your head?
Off the top of my head, no.
Okay.
I just checked that around. It was closer to, I think, where we are right now, after this up move that we've seen.
388.
388 was the price.
Stock hasn't really kind of taken off even after the multiples.
So, yeah.
And the deal happened in July of 2025. So 6 months in, the stock is where it is. And this is after the up move today.
Yep. That's after the up move. So which is why, the belief that it was an underperformer before this up move, and now it's pretty close to where it was. 388 is where it is. Manish, the travel and tourism space, and also the luggage space in particular. There's VIP, there's Safari in the listed end of things. Safari has obviously crossed VIP in sales, market share and market cap by a long distance. But right now, what we're seeing is this is ripe for disruption from other new age brands as well. There's Mokobara. There is, at the upper end, Ethos has brought about some of the luxury brands here. What do you make of this space and many such which are ripe for disruption?
So we own VIP. So very positive on this space. Mind you, the luggage industry is a duopoly.
Yeah.
To say, maximum market, or let's say 3 players, Samsonite, Safari and VIP. And the majority of the market share is basically by these 3 players. VIP got it wrong where they were late in moving to the online space, ceding market share to Safari. And Safari has really done well. Samsonite has been a laggard so far. They have, today's news suggests that they are upping their capacity in Nasik by 7 lakh units per annum. But, the luggage space is becoming very, growth intensive. 6 lakh passengers traveling by air, around 1 million passengers traveling by road, 1 crore passengers traveling by train every day. And it's no longer just carrying luggage. It's more of a fashion statement. The Gen Z millennial will look at luggage also to be changed during time intervals, not the usual 10, 15 year. Now it is replaceable every 3 to 4 years. Now, having said that, 1.4 billion people in India have that recall value of VIP. Everybody understands VIP. So I think with the change in the management, their undoing of the previous strategies, following a consumer-centric, moving to online. Last quarter, they had a kitchen sinking quarter whereby they basically loaded all the expenses and the write-offs. That is why we saw the stock dip below 388, which was the open offer price. But at this market cap, and given the fact that it's only a matter of time when they could claw back their market share. And mind you, the unbranded guy, the D2C guys, this is a category which requires a lot of expenditure to build traction on top line. It's not a very easy category to penetrate. So yes, you may have newer brands come through to find top line, but it's a loss-making proposition for a very long period. So how many of them would survive really is the key. But on the whole, I think there is value in VIP, even at these levels, albeit Safari is doing very well in the current circumstances. They'll also do well. So quite positive on the luggage space as a whole.
Manish, what about Shriram Finance? 6th consecutive day of gains now, and the stock is trading well above the deal price of 840. Where does it go from here? Are you positive at this level?
Shriram Finance, the valuation difference between Chola and Shriram is quite big even now. I think we own Shriram Finance, and I think the cost of funds will come in lower because 40,000 crores worth of capital infusion will definitely reduce cost of capital, and their funding costs are going to come down. They'll apply for a rating upgrade, and they will have better leverage on the volume front. And the valuation difference between entrenched players like Chola Mandalam seem to suggest that there's even more upside from the current.
So Manish, to sum it up, if I were to ask you your top 3 themes for 2026, what would they be?
So I would believe that discretionary consumption, and more so premium end of the discretionary consumption, And mind you, out here, one little insight is that brand salience today is getting diminished, except for four categories, which is basically automobiles, jewelry, real estate, and one more. So all these sectors would have salience on the brand salience, but others like consumer durables, etc., are losing their relevance on the brand sanctity. So out here, premium end is where we'll be focusing on. Capital market as a theme looks very, very entrenched even going into the next year. And rate sensitives as a whole, currently automobiles is leading from the front, but other rate sensitives like banks, insurance, real estate, they will also continue to do well.
Okay, so you're saying discretionary consumption, more the premium end, the rate
Capital
sensitives and capital markets. So there's a fair amount of a financial mix out there.
No, I just wanted to know his thoughts on some of these new age players. We've had, Lenskart, Meesho, Physicswala, all these. There was an initiating coverage coming in on Nykaa the other day as well. Eternal, quick commerce, always in focus. So what's your thought on this entire space?
So I was fortunate enough to buy into, let's say, Pine Labs and Grow on the first day. These are very good companies, according to me. You could have technical factors of float adjustment in these initial days of listing, but I think the growth in Grow is likely to be 35-40% for the next 2 years, according to me. A 2,000 crore net profit this year, translating and going forward into the next year, maybe a 3,000 crore profit on the back of a 15% top line growth. Half of that coming from subscriber addition, half of them coming from ARPU increase. That should give us a massive operating leverage, translating into 3,000 crores of PAT. And going into the next year, around 4,000 crores of PAT. So around 35-40% CAGR growth rate in profits with a very high very high ROEs. And mind you, the profit growth is going to get channelized into building businesses like distribution, margin trading, and all of that. So I think 26% market share in active trading accounts on BSE and NSE, and the turnovers are only going to grow over a period of time. These guys have an entrenched moat. The tech capabilities, because these are ex-Flipkart guys, they understand technology much better than the phygital brokers, and that would give them the UI UX interface advantage, ease of navigating through the apps. That stands as a competitive advantage. Pine Labs, again, is a play on upscaling of consumption. It's a payment aggregator, of course, straddling both online and offline, moving into international markets, and out here also is a growth parameter because margin expansion due to high operating leverage looks good. And, trading at a valuation discount to peers, Zaggle or Paytm, etc. So these are the two names that we own. Others, I don't find the valuations very lucrative, but some of these businesses are good, but valuation may be the only hindrance. Many more companies in the new age area is going to come for IPO in calendar 26. We'll keep a tab on them and evaluate.
Okay, so Pine Labs and Grow, two of the new age listings that have met the mark for Manish. Thanks for that. Manish, before we let you go, last 10 seconds on the conversation. Some of the poster child or the poster boy, poster girl sectors of the market, they seem to be under a cloud as we're closing this year, and EMS probably tops that list. There's a big debate on EMS now. Some feel that after a big correction, 25-30% correction, the stocks are again looking good. Some feel that maybe still overvalued and it's too closely linked to PLI and whether you have PLI or don't have PLI. Where do you stand in the great EMS debate?
So some of these players have run up quite a bit and probably discounting FY28, FY29 numbers. Currently, the apprehension is that rupee depreciation is going to hurt margins quite a bit. And that would be the key monitorable because these are low margin businesses. They have a lot of volume, visible volumes come through. That is not a problem. PLI is not a problem. Valuations are a problem on the back of margin concerns due to depreciation of the rupee because imported raw material as a portion of your bill of materials is still quite high. So from that perspective, valuations may go out of sync. So that is the apprehension.
So you're not buying the dips in EMS? Okay. All right, Manish, we'll wrap it up on that note. Thank you so much for joining in. Great conversation as always. Let's also take this opportunity of wishing you a very, very Merry Christmas, a very Happy New Year. May it be positive for you, your teams, your family in every way. Thank you for joining.
Very happy Christmas to you and CNBC and all your viewers, Surabhi. Also.
Thank you. Thank you so much. Have a great day.